Today's event is entitled Capital 101, and during the session, we'll explore the funding opportunities available to growing tech companies. First, it's my immense pleasure to introduce Bruce Townsend, Director of Growth and Transition Capital at BDC.
Glad to see such a great turnout. I think we're going to have a great discussion today. So thanks to you, Erica, and the BC Tech Association for the opportunity to be here. As Erica mentioned, you can probably see in my little video screen there, my name is Bruce Townsend. I am the director in BC's Growth and Transition Capital Group. I focus on offering debt solution for BC's tech sector. And as Erica mentioned, I joined BDC earlier this fall. Before that, I was with a local software company called Ecotagious. The reason I'm just bringing that up again is because I've seen both sides of the table. So not only have I sought debt and equity financing, but now I'm offering it to the BC tech sector. So with that kind of background, I'm going to set the stage for today's panel with an overview of the financing options that are available to help you fuel the growth of your tech business. I do want to mention that the reason BDC wanted to sponsor the session is that it's our mandate to be the bank for all Canadian entrepreneurs, and it has been for over 75 years. So we are a Crown Corp, and we do work hard to complement the role that's played by private sector banks that we all know. And we do that by offering a couple of solutions that range from financing traditional business assets like equipment and real estate, to providing debt and equity capital to finance growth and acquisitions for your business, to providing the advisory services that are going to help you scale fast. So we have a very strong focus on the tech sector. We have over $3 billion in loans and investments in over 3,500 tech businesses across Canada to finance their growth. So while BDC offers a lot of the solutions that we're going to be talking about today, this overview that I'm going to provide over the next couple of minutes is more of a general market overview of debt and equity solutions for tech companies. When it comes to financing and your capital stack, it's typically broken down as to whether it's dilutive to your shareholding, like equity, or not, like debt. Now, there is a third category of funding that I know we're all very aware of, which is the government grants and tax credits, like NRC IRAP, SHRED, SDTC, and others. Now, these are wonderful sources of non-dilutive funding that you should all be leveraging to grow your businesses. I know I did. However, they're not going to be the focus of what we're going to be talking about today. So what we are going to start with is dilutive financing options. And the most common form of that is priced equity. And I'm sure you're all are familiar with it. This is where you issue common or preferred shares and agreed upon price. There's no set schedule to repay your investors. The expected return occurs at some point in the future, often through the sale of the company, or even possibly through an IPO, or even possibly through a series of dividends as you turn cash flow positive. A second form of dilutive financing is the convertible note, which starts out as debt, but eventually converts into equity in a future equity raise. So it's often used as bridge financing to get you to your next milestone where you can raise equity at a higher share price. The loan typically has a fixed term, at which point the convertible note investors can choose whether they'd prefer to have their principal back plus a modest interest rate, or whether they'd rather convert the loan to equity at a discount to the latest equity round's share price. A third common form of dilutive financing is the SAFE, which stands for Simple Agreement for Future Equity. This is a fairly new tool that's come out. The key word here is that it's simple. So in this case, an investor provides capital to your company in exchange for the right to purchase shares at a discount to the share price in the next equity round. So it's very similar to a convertible note, but there's no interest paid, and investors typically have fewer rights. So for example, there's no maturity date, and if the company never ends up raising equity, the conversion to equity shares may never actually get triggered. All right, let's turn our attention now to non-dilutive financing, which is essentially debt. The most common type of debt is the term loan. So it has fixed principal and interest payments every month. And at the end of the loan, there's no outstanding principal to be repaid. A secured term loan has collateral. So that means that there's a tangible asset like real estate or equipment to back it up. So as you can imagine, these are the safest and most restrictive loans. so they actually have the lowest fees. The second type of term loan is an unsecured term loan, which has no collateral, and the bank, like BDC, is really relying on your business's ability to generate cash flow to repay the loan. So in this case, it's a great solution to fund working capital for organic growth or even acquisitions. A common second type of debt is the line of credit. It's also referred to as a revolver because you can borrow, repay, reborrow again, repay, and so on at will. It's a great solution if your business has seasonal cyclicality. Fees are typically only involve interest on the outstanding balance at any given time, and the credit limit can either be a set amount or can be margined against your assets. So, for example, you may be able to borrow up to 50% of the value of your accounts receivable or your inventory at any given time. Now, a third type of debt is a broad category that I refer to as mezzanine debt, because it's typically subordinated to the term loans and lines of credit above it, but it's paid out ahead of the equity below it. So it sits in that mezzanine layer between the two. And it's actually a group of solutions that share some common characteristics. So they're typically used to finance an acquisition or to finance working capital to grow organically. So the intent of these loans is really to try to keep as much cash in the business for as long as the business needs it. So your principal repayment may be partially or completely deferred to the end of the term, or it may be based on the profitability of the company each year. You have a very good year, you have lots of profitability and cash flow, then you may be repaying some of that principal as a result. Some of the fees may be deferred to the end of the term as well, and some of the fees may also be variable, which means that it may be aligned with the success of the company. So one example of that is for example, a revenue royalty. So there are a couple of different subtypes of mezzanine loans. One is the traditional mezz loan that are typically provided to businesses that have been and are expected to continue to be cash flow positive. MRR loans are another type of mezz loan that are well suited to SaaS businesses that have growing MRR, very high gross margins, and they have a path to being EBITDA positive within the next 2 years or so, which means they don't actually need to be cash flow positive today. They just have to have line of sight. Quasi-equity loans are another type, and they're well suited to businesses that want to extend their equity runway or delay their next equity round until they can further increase their share price and valuation. So they typically have high revenue growth, though the revenue may be early stage. They're very often cash flow negative, but they have the potential for significant value creation. So these quasi-equity loans typically have no principal repayment before the end of the term. It's all paid at the end. They have no or low interest payments along the way. So you're keeping as much cash in the business as possible, and they have a variable return at the end of the term that's aligned with the success of the company. Venture debt is a type of quasi-equity loan where the lender is actually lending alongside a VC, and it's often going to piggyback or outright rely on the VC to perform the due diligence. So as you can imagine, these loans are the riskiest loans there are. So while the interest payments may be low, the variable returns are going to make them the most expensive loans there are. They will be, though, most likely much less expensive than equity. So the last type of loan I want to touch on very briefly is IP loans, which are well suited to businesses that have invested heavily in IP. They've been granted patents for that IP. They are intending to pursue revenue generation through royalties, for example, and they're starting to generate that revenue. So you've likely noticed a couple of trends as I've spoken here. I just want to point them out. Your term loans are going to be the first to get repaid, and your equity gets what's left at the end. Your capital becomes more patient, and your principal repayment becomes more flexible as you move from debt to equity. And your cost of capital increases as you move from term loans to equity as well. So this gives you a kind of sense as to how it all kind of balances out. All right, now let's take a look at how we can find the right mix of debt and equity for your business. So in finding the optimal financing mix, there are some financial and non-financial considerations that you should be thinking of. So let's consider equity, which is dilutive first. So the pros. You can bring in far more equity than debt alone, and you can bring it in much sooner, which means you can scale very fast. Equity is patient, which means there's no stress in making payments. You can focus on making wise, long-term, value-creating decisions rather than being forced to make rash, short-term, loan payment-driven decisions. If you pick your equity investors well, they're going to bring much more than cash. They're going to bring networks and expertise that you may not otherwise be able to replicate. The cons, you give up a share of the value pie forever. You give up votes, and you often give up board seats, which can translate into giving up control and even being replaced in your executive role. And while the cost of equity isn't paid until later, it is higher than debt. So while debt is likely going to cost you in the range of 5 to 20% per year, equity is likely costing you 20 to 35%. And equity raising takes time. It's usually 6 months of full-time effort at minimum. And then once you raise, you actually need to then start reporting to those shareholders and instituting the necessary governance processes and structures as well. So you need to keep that into account. Let's now consider non-dilutive debt next. The pros: you avoid dilution of your current ownership and future value creation. Unless you break the debt covenants, you're going to retain control. And if your venture is a success, the cost of debt is going to be lower than the cost of equity in the long run. Another bonus is that the interest is tax deductible, which makes the debt even less expensive again. Debt can be structured to build in the flexibility that your company needs through either deferred principal payments or cash flow sweeps that repay the principal based on your company's financial performance. The cons are that on the flip side, repayment terms can sometimes be a drain on your cash flow, and it could therefore slow your growth. Getting a loan could require collateral or a personal guarantee, particularly if you're early stage and early revenue generating. In case of a downside scenario, your lender is going to be repaid in full before shareholders can recoup any value. And in a lot of cases, debt financing lacks that value-added advice that comes with equity investors. Most lenders aren't able to replicate this. I will say that as part of BDC's mandate to support entrepreneurs, we invest very heavily in offering advisory services alongside to our financing to our clients. There's one takeaway for today, for you and for value. It's that an optimized capital structure for your tech company is going to, of course, start with equity, but it's likely going to be able to leverage debt much sooner than you would expect. You're going to want to balance reducing your cost of capital by using debt while avoiding the risk of bankruptcy. And your structure is going to depend on your company's growth stage and trajectory at a given time, and it's also going to evolve over time. And any debt that you bring on can be tailored to suit your business's specific cash flow needs. I know we do that on a regular basis at BDC. So thanks for your attention. Let's move on to the panel discussion, which I think is going to be way more interesting than what I just talked about. I'm definitely looking forward to it. If you do have any questions that you want to discuss with me after the panel, either today or over the next coming weeks, I'm going to leave my email address in the chat so you can contact me at your convenience. Thanks very much.
Great. Thank you, Bruce. That was very informative. And I'm really looking forward to hearing from our panel about their experiences. Before I introduce the panel, just a reminder to the audience that today's session is interactive. So please post your questions in the chat at any time, and we'll do our best to get to them. First, I'm pleased to introduce today's session moderator, Olga Galubeva, a senior account manager at BDC.
Thank you, Erica, for the introduction, and Bruce for the great presentation. And thank you, everyone, for joining us also for this call. So let's start off by hearing from each of you in your own words and share a little bit about your careers and your companies that you're working for. Daryl, would you like to start?
I just got nominated. Okay, so I'm Daryl Hatton. I'm founder and CEO of ConnectionPoint. We're best known in Vancouver for our fundraiser enterprise crowdfunding platform. I'm a serial entrepreneur in that I've started a number of different companies. One of them we started way back in the 90s and took it into a public offering in December of 99. The company was called Optio Software. I was one of the senior team and on the M&A team for that. And then, 2008, took the company private again, sold it to our largest competitor. And a short time after that, I started ConnectionPoint to get into the business of collaborative funding, helping use social media and other mechanisms to fund important projects all around the world.
Thank you, Daryl. Simon, would you like to go next?
Absolutely. So hi, everyone. I'm Simon. I'm the CFO of Tasktop Technologies. We're a Vancouver headquartered software company, 200 people. And we work with large enterprises and help them get their software products to market more efficiently and more effectively. In terms of my background, I spent the first half of my career with a Big Four accounting firm, working in the UK, in Europe, and in Canada. And then since 2008, I've been the CFO of a number of different fast-growing technology companies. And they've all had similarities in that they're all growing really fast, they all need help scaling, and they all need money. And in terms of Tasktop, we've been around for 15 years and we've done the whole gamut of fundraising. We've gone from the SHRED programs, the government grants, through multiple venture rounds, and now we're into the private equity world. So, lots of experience of seeing different kinds of money and scraping pennies from wherever you can.
Thanks so much. I'm going to let Nima present himself.
Yeah, thank you very much, Olga. So my name is Nima Ziraknejad. I am the founder and CEO at NZ Technologies. We are also a Vancouver-based company. We are specialized in building touchless human-machine interaction devices. These are devices that we originally started in the past decade for the medical field. So our products, which we call them TIPSO, they have revolutionized the state of human-machine interaction in the operating room. So we enable surgeons and medical practitioners to touchlessly interact and navigate with medical imaging and or operating room equipment while they are scrubbed. So this technology is revolutionary, and we started that about like 10 years ago, and now it's been hired in many hospitals here in Canada and internationally, and we are so proud of that. Of course, at the time of COVID, which started almost 2 years ago, we noticed that the need and the demand in our society to bring this technology outside of the medical field and bring it and make it available to the general public. And that's why you heard in Olga's introduction that we started to apply this technology into the elevator industry by building touchless control systems or touchless navigation system inside the elevator cabin, which has gone very successful right now. And we have a number of luminary sites and test sites, and we are expanding our international presence for this touchless technology. And I am happy to be on this panel and have some wonderful discussions along with the rest of the experts here. Thank you.
Thanks so much, Nima. And Andrew?
Hi, I'm Andrew Booth. I'm the CFO at Abcelera. That sounds really cool, Nima. Actually, I'm interested to learn more about that technology. So I've been at Abcelera for a couple of years, and prior to that at Stem Cell Technologies for about 10 years, as it was said in my intro. During that time, I think I can safely say I've used all of the types of financing or experience with it that Bruce mentioned in his overview. And over the period, I think I haven't added it up, but I've raised to fund businesses, well over $1 billion US. I think it's the sticker is probably at. So yeah, happy to provide any of the insight that I can to people trying to also scale their tech companies.
Great, thanks so much, Andrew. So this is a question for everyone, and I also encourage the audience also to post some questions in the chat. So this one is for everyone. From your perspectives, what are some of the key considerations that companies need to take into account when raising funds to grow their businesses?
So yeah, so that's a great question. In terms of in my experience, it's all about risk and how we can as entrepreneurs or bringing something new and in order to create jobs around that something new is about how we can de-risk the platform for whoever, even for ourselves as entrepreneurs, because along the journey that someone have in terms of like bringing technology into market and commercialize it, there is a variety of like expertise and people who will come and and help the business. I think for all of them, taking that risk is really important. So if I speak from my experience in our business, where we started with a very, very risky technology. And the reason was because it was about 8-9 years ago when a group of surgeons, for example, from Vancouver General Hospital, they approached us and they had a problem in their operating room. So when they wanted to interact with radiology images, which is a critical aspect of the image guided therapies, these surgeons, they have to basically use the mouse and keyboard in order to go over the layers of CT scan or MRI and zoom into the MRI image and doing the navigation during the surgery. But they had to scrub out, go to the control room, which is a non-sterile field, and use the mouse and keyboard. So their problem back in that time was that how we could help them in order for them to stay at the bed and touchlessly using hand gestures and devices that enable touchless navigation of medical imaging, how these surgeons can stay at the bed and do their operation. So as you can see, it's a very niche process, and not many people know about this. It's not something that is basically known in the investment world, and it's a kind of a business that you really need to start from scratch. And that's why there is a high risk associated to that. So how did we solve that very early problem of how to de-risk this? Of course, in the presentation we saw earlier from Bruce, thank you very much. That was a very informative presentation, Bruce, that the government comes into help here. The Canadian government is great in terms of having a number of funding and grant opportunities to help entrepreneurs to de-risk that very early stage of the business. Because we need to build the proof of concept. We need to build that minimum viable product that at least you can demonstrate the usefulness of this technology or this device to your audience, whoever they are, investors, your own people. If you even want to hire more new employees, they need to actually understand the process and if it's worth it to put their time and energy into that, right? So basically, going back to the question of what are the key considerations? I think in the beginning of a business is how to de-risk the technology and the idea or anything that you are building. How to de-risk that by bringing the early capital into the business and be able to build that very first demonstration of your product of your idea. And then once it happens, along the way, you need to see basically who are those people who can share some of that risk with you, and of course have that vision to help you, and how they can share the risk with you, and they can basically bring it to a stage that the next level for that is to basically see how big of a market there is for this device. For example, in our journey, for example, doing this technology development for the surgery room, it took us some time. And again, for example, you had to basically apply for all the safety certifications. You need to basically be able to bring this product into, in our case, to hospitals or to that very environment that you need to bring it. How can you de-risk that presence in that environment that you are going to? In case of hospitals, of course, is one of the most difficult environments to bring this technology in. Some industries are easier. I have worked in mining industry, in automotive, in oil and gas. For example, in my experience, mining is very interesting industry because in the beginning, you don't need to have all those certifications and all those safety aspects of a technology being brought, because the environment can tolerate that. Of course, at some point you have to have all of them, but it's very important. In the hospital, you can't just bring a technology and just use it right off the bat. No, that's not the case. So these are so if I want to summarize this section of my talk, is how to de-risk the technology and how to basically de-risk the platform for your colleagues and for your investors. These are the very first, I would say, a consideration that one might have to start the business.
Great, thanks so much, Nima. So what I'm hearing is really a question of risk. So that's the first thing you consider. Sounds
yes.
Good. Andrew, being a CFO of the company, would you like to maybe add something to this question?
Yeah, I would say, as Nima has mentioned, risk is one element. I think what I've seen is it's also a match. So as Bruce mentioned, there's a lot of different tools in the bag here, and just something when everybody knows, it's critical who you're hiring on your team. when you're taking out financing, you've got to be thinking of it almost like you're hiring someone and they have to match what the role is you're asking them to do. And so if you've got something that's very risky, then you need government funding. It's a good match, for example. If you need to control the direction of your company because you're maybe doing something that's extremely, you need to prove out a number of certain points in the technology before you want to raise equity and not get too diluted and lose control of the company, you need to find a way to bootstrap along in order to do that and not get diluted. If you're going, and you could go through the entire list of all of the tools that Bruce mentioned, but the important thing is, like, what are you trying to do? What is critical to the success of that? What is the right match of the available type of funding, debt, equity, in the whole government funding, grants, IRAP, SHRED, in the whole range of what's available, and figure out how to get it to match. And if you do that, you avoid yourselves problems. Where people get into problems is where they've got the wrong type of funding for what you were trying to do. And then that gets you in trouble sooner than you know, and can end up compromising the longevity or the scalability of your company.
Wow, that's a great answer. Thank you so much for sharing that. So use of funds and also timing and when the funds are actually needed. Daryl, Simon, would you like to also maybe add something from your points of views on this question?
Sure. I've got one that I think is a little bit shorter and easier to summarize, and that is, I look at a lot of these things in terms of the relationship with that organization that's funding it. And what are the characteristics of that relationship and how can it be best leveraged? Some of the best relationships that we have going on now are with investors who are bringing us into new deals, to new business, to new influencers in the market, et cetera. There's much a higher value add than the simple financial aspect of what they've done and the match of that. I think Andrew's comments and Nima's comments are really important about that getting the right fit with that and finding the way to manage the risk. But I look at it as, can we invest in that relationship? Because we've struggled in a few different areas as we've grown and hit some big challenges. And having those relationships helped us get through that period better than just the financial aspect of what happened. We could have gone for other money to help bail us out, et cetera. But being able to call on those relationships, building the strength of that relationship got us through some areas that we may not have survived otherwise. So I think of funding as a relationship aspect.
Thank you. Simon, would you like to add anything?
Well, I'll try. I mean, there were some really good answers there. So, the one thing I'll try and do is play off Andrew's a little bit, and the matching of the funding to the activity is really key. But funding is never a one-off transaction. It's always a bridge to somewhere else. So I think when you go into raising money, what you should always be doing is looking at what are you trying to achieve and what happens next. So are you trying to prove a product? Are you trying to prove a market? Are you trying to grow to a certain size? Always have in mind what you're trying to achieve, and then make sure the whole team is on board with what you have to do with the money you're raising. Because quite often, you'll bring in some money and you want to get to a certain stage and then do a big equity round or something like that. But in order to be successful at that second stage, you need to have proven a few things along the way. So make sure you're thinking beyond the today as to what you hope to get out of this next raise.
Plan ahead, definitely. I just want to maybe go a little bit deeper on that topic and talk a little bit more about the dilutive versus the non-dilutive capital. So from your perspective, what are some of the pros and cons of these options? I know Bruce did a fantastic presentation on it, but more hearing from you, what are the most important things you were looking at? What are the pros and cons of those two different options? Whoever wants to start.
Shall I keep going?
Sure.
Bruce did give a really, really good summary there on his slide deck, but I think from my perspective, it's always that, what are you bringing along with the money? Are you bringing expertise? Are you bringing a loss of control? Are you bringing people onto the board? Versus do you just have some money that you can go and play with? And I think on the debt side, for sure, it's a matter of understanding, are you comfortable with it? There's definitely an element of people being concerned because it does come with repayments. It often comes with covenants and requirements to run your business in a certain way, and you need to make sure that you're understanding those, you're kind of planning them out, and you're really kind of taking every component into consideration before you go down one of these routes. Both options are great for different elements, so you just need to kind of look at them and go, what am I getting?
Yeah, I would say as well, although I would say that the expertise side of equity is often overrated in terms of how it actually plays out. I would say, yeah, if you're a retail store and you bring in equity from someone who's a landlord who's got a lot of shops, that'd be great. But in the tech company, you know, by nature of being a tech company, you're probably out there trying to do something that no one's done before. And you probably want the equity that's coming in to just side with management and allow you to, and be patient for you, because your tech company is going to take a long time. If you're relying on your investor to come in and tell you what to do in this tech market, you probably don't understand the market. You know, that investor is not waking up in the morning every day in the shower thinking about your market, your technology. They're managing an entire portfolio. The chances of them being an expert to be able to tell you what to do are very, very low. So I see too many people raise equity and believe they have the right equity partner that's going to open all these doors and do all these things, and it never really plays out. I think the way the expectations are in the mind of the operator. So that's one of the pros and cons that I'd just be very sensitive to, missetting expectations about how much value add can be brought.
Very good point.
Hey, there's one piece, Olga, if you don't mind, I'm just going to step in. There's one piece, other piece that I kind of want to cover off here too, which is, again, it's kind of matching the capital and so on. And I kind of think of it as being, you know, you've got two different extremes on the continuum of types of business that you plan on building. One is, for example, the lifestyle business that we all know of, right? It's like, I plan on running this thing for the next 25 years until I retire. It's going to be cash flow positive. And it's going to have nice, you know, wonderful 20% growth. But I'm not, you know, it's not going to be the immediate land grab, right? And then there's the other end of the spectrum, which is the one which is, you know, it's a new market opportunity, and you are trying to build Vancouver's 14th unicorn, right, in under 3 months. And that's the other extreme. And you need to make sure that you're very well aligned with your capital provider for those, because, you know, when you take a look at the venture capitalists who are going to be interested in the next unicorn, they're expecting 1 in 10 of their portfolio companies to make it. And that's going to provide all the return, repay all of the principal for the other 9. And you know what, you know, there's some great work that Boris Schwartz has actually shown as well in terms of returns, you know, for his portfolio of 20 companies that he did over the first couple of years and so on. But it really is that top one that provides all the return. That's what they care about. The debt side, if you're talking about the debt side, your debt supplier has 10 companies, they can't have a single one of those 10 not repay. And so that's a very different model that you're looking at. And it's probably better suited for your, let's call your lifestyle tech company that's growing at a meager 20% a year. I'm being facetious, but it's a very, you know, you need to understand, and you have to be aligned. You have to make sure that you have those conversations very clearly with your financing partner as to what your intent is and how you're going to get them their money back. Is it sale, right? Which is 80% of the exits. Is it dividend cash flow over the next 25 years? It's got to be clear. Or is it just, you know, interest payments?
I don't know if Daryl Anima also wants to add something else to that specific question, or
yeah. So I want to actually, there were some really nice topics that Bruce, Simon, and Andrew, they were pointing at the right direction. Of course, from another perspective, we look at it is all about the trust and the channels that when you look at the dilutive funding and the entity or the person, I mean, take it from angel investors or even from, like, you know, venture capitals, that it's all about, like, to understand that what channels and what opportunities they will bring to the business. at some point, for example, and is it worth it that, for example, if you bring a group of investors, for example, to your company, how instrumental their role will be in running this business and helping you to open even more doors. I can talk about, again, as an example for our company at NZTech. We are a medical device company. It was very instrumental for us to bring those investors who are familiar with the medical field. Who is better than surgeons and medical practitioners? So we have a number of surgeons who have invested in our company. And of course, that is a dilutive process, right? But the beauty of that is that they have really helped us. We have really taken advantage of having this opportunity to work with them and, expand the opportunity in your business to a variety of more applications in the medical field. Why not? If these guys help you, if these guys genuinely, of course, help you, and that's a consideration that one should make in the beginning of the business, that whether these guys will be really helpful, of course. That's a great thing to do. I mean, I think it's worth a lot. In my experience, it has been really good. I have never regret in doing that. And it's all about the channels and the opportunity that your partners can bring to this, to the journey that you are in together.
So choosing the right investors and creating those synergies.
I would call it a strategic investors or a smart money. That's all about bringing a smart money and bringing a strategic people that can help you along the way.
Great. Thanks so much, Nima. Daryl, would you also like to add something else to?
I would just add on to that briefly. The idea of that strategic investor is very important. In our case, we are launching a new version of product based on our current platform that we call CocoPay. And it's a crowd financing application. What that does is allows patients in the US who are crowdfunding for medical expenses to do it more safely by having it done in collaboration with the healthcare provider. So as opposed to putting the money in GoFundMe and collecting it and then paying for services, we do it differently. And the investor group that we've been bringing in has been instrumental in opening doors with major healthcare software providers and revenue cycle management providers. And as we focused on getting some American investors in this case because they understand the problem. They have the network connections that got us in a way that as a small Canadian company, without them, would have had great difficulty penetrating some of these organizations and speaking at C-level right from the first meeting to have that decision made. So the strategic value of those investors was huge in getting us early traction on this. So I agree. I think properly selecting your investor group really can help you do some of that. And again, that was, back on the theme of trying to work the relationships here. We're constantly in contact with them because they are front-running deals for us at this point.
Thank you. And since we're on the subject of equity, of dilutive funds, there's a question from the audience, which is, would you still consider another equity raise, even if you do not need it now or the near future, but the investors have a good appetite for it?
I'll try that one. I would say, again, it's a matching question. If the market is particularly good right now and you can raise funds and your business plan shows that you don't have enough funds to actually play out the business model as you're planning to do. And yeah, you don't need it now, but you do know you need it 3 years from now. Well, you have no idea how the market is going to be in 3 years' time. And would you be better off to be raising it now at a valuation you're comfortable with a partner that matches and fits? Then that may be a good idea. Do you need a bunch of extra cash on your balance sheet just for the sake of it? No, you better have a plan of how you're going to use it, why you're going to need it. So, but if the market is good, you like the partner, there's a willingness to invest, and you have a real use case for it on trying to fill out your long-term vision of the company. And they are also aligned with that long-term vision of the company and are not going to all of a sudden pressure you to sell or exit or do something that is not a fit for what the natural growth of the company would be, then that would be a great use case about when to take it. But you're not always in that use case. So it just has to make sense with what you're trying to do with the business.
Great, thank you so much. As time is running quickly, I just want to maybe also jump to the next questions as well. And whoever wants to answer, please do jump in. Bruce commented, because I think we have a good conversation about the equity side, but Bruce did comment also about the debt side. So for all of you, in what circumstances should you take on debt when you're still burning money?
We took on some debt recently, Olga, as you well know, and one of the pieces of that, and by the way, relationships with Olga have been phenomenal. One of the reasons we did that is that we were feeling like we were having difficulty telling the story of the value that we had in the company at this point. And by taking on a debt level, it was helping us not have to sell as much equity at a discounted price from what we thought we could get for it. So it's given us an extension in the time frame to build the value that we needed. We felt it was a really appropriate time to take that on to firm up what we offered before we went further with an equity round. And so it's been very helpful from that point of view.
Thank you, Daryl. Sounds good. Thank you. And so also another question from the audience from Miranda. Can you explain matching funds to use of funds a little bit further? For example, R&D. What is the best fit, equity, risk, or debt?
So you'll rarely find a debt provider that will fund R&D. As Bruce said, there's usually needs to be some kind of underlying security or covenants. And spending lots of money on R&D is unlikely to be a covenant that your lender will accept, right? So I think, when you're funding R&D, grants, shred funding, for example, seem to be like the very early stage stuff, NRC IRAP, Strategic Innovation Fund, lots of government grant programs if you're going to be bootstrapping your company. Otherwise, you probably have to go to, depending on how early your company is, like the angel investor in order to proof of concept out things before, early stage VCs might be interested, but then that's going to be in the equity side of things.
Thank you, Andrew. So I know that we have a lot of entrepreneurs and startups in the audience. What are some of the strategies that you think really work for pitching to investors and securing capital?
Shall I start there? I think one of the key things is start reaching out to people before you need money. Don't just kind of sit there one day and go, hey, I need money, let me go ask. I think you've got to go out there, you've got to sell your story, you've got to get to know people, understand what options are available to you as a company based on what you're doing and your stage. And sometimes it's done for years before you actually need to raise money, but you have to go out there and build those relationships and get to know who the right people are for the different stage of your business. There's going to be some equity providers who are really interested in a certain space. There's going to be debt providers who operate and help you in certain stages. There's going to be at some point the question of whether you do venture debt versus a big equity raise. But start talking to people, build trust with individuals in the community and make sure they know who you are, what you're trying to achieve. So when it comes time to raise money, you don't have to explain who you are. They know what you're doing. They're already excited. And then all of a sudden you've got the right people at the table to start that conversation.
Very, very nice point from Simon. I mean, along the same path that he was mentioning is all about that investors invest in you, or in the entrepreneur, or in the person who is starting this business. They never invest in the, at least early investors, they never invest in the technology or in the device or the product. They invest in the individuals that are running this business. And it's very important for them to understand the vision that we have in order to run this business, and whether it's a short-term vision or a long-term vision. The individual who is starting, or the individuals who are starting the business, they need to build that trust in the investors that they are the man or the woman of doing the jobs, okay? And are they gonna stay around? Or is this just some sort of an excitement or some exciting ideas that they have and tomorrow they might change their mind? So it's all about the journey that you need to show that, you have this vision and you have this excitement to go all over this and tolerate a lot of pain, okay? They need to see that you will going to develop a thick skin, in the game. And because that's not easy. Starting a business from scratch, to my understanding, at least to my experience, is the most difficult job, in the world, in my opinion. So they need to understand that you are the man or woman of the job, and you can do this. I think that is really important.
Add on to what Simon and Nima were saying there about the starting the relationship early, and then I would consider part of that is do what you say you're going to do. So part of the purpose for doing that is saying this is what we're planning, and then showing the progress towards that. It is such a high, strong way to show that you're reliable, you're trustworthy, etc. in the business, that what you're predicting and what you're aiming for are achievable, and that you're showing the achievement. Now you have to balance that with the whole idea of a startup being it's a business in search of a sustainable business model, which is going to have significant amounts of change. So my opinion on this, and I don't know that it's always shared with some people, is a lot of transparency. Just trying to talk about what is actually going on, what we experienced, some of the failure that we had along the way, helps build trust in you as the leader and in the group. It's a balancing act because it can make you look awful at the same time. But part of this, it's a messy game that we start to play in the early stages of startup. And I believe transparency in talking to the investor group is helpful.
Thank you, Rob. So as we only have about 6 minutes left, I just want to ask one last question, and then I'll leave with Erica to finish the presentation. So what final words of advice would you give to other BC tech companies who are looking to grow their businesses?
I'm just going to quickly jump in on one topic that we just really noticed in our recent round, is that we've gone into an American investor group in order to try and get some market awareness and the leveraged connections that we had. One of the things that we were also selling is the benefit of being a Canadian company. A lot of these groups did not understand the high levels of support that we get from government, some from BDC, from Shred, from IRAP, all the non-dilutive sources, plus, the lower cost of operations and things like that we have. So it was important to remind them about these aspects as we were selling in our round. And, the little side note that I've got is that we're also qualified under the BC Small Business Act. So the local investors are basically getting a nice discount on anything that our American partners are bringing in. And so from a home team advantage point of view, I like to give the fact that the local investor gets a discount on it. And it's worked out very well so far.
Yeah, I think, Simon, that those are really important points that Daryl mentioned. We do have, like we said, it's about matching those funds and the investor and the partner. And we do have a lot going for us up in Canada. So make sure you're familiar with all those tools, including EDC, which is I know is another great Canadian funding partner. And just, I guess the key thing is just be careful. It's like interviewing an employee who is going to take a strategic role in your company when you're deciding who is it you're letting onto your cap table and whether they have a board position or not. There are responsibilities that you have to that person or to that fund, and you have to treat them like an employee. So you better make a really good, and it's an employee that you can't fire, right? Because they're now on their funding, they're on your cap table. You can't fire them. So you have to be so careful. It is a permanent hire you're going to make typically. So just be very conscious of that when you're making that selection.
Great advice.
Yeah, and I think in BC, we're lucky. There's a good community of tech entrepreneurs in BC. There's a lot of experience. Just recently, we've seen an awful lot of success with companies really hitting that scale. Build a network, build a bunch of peers that you can go to and walk through some of these things. It's not a straight line. I mean, this is a tough job. Make sure that when you get to the point and you're sitting there going, I've got to make some decisions, and I don't feel like I've got the local support, that you can go to the community and just ask. Everyone in BC is really helpful, and you'll always find someone that will offer some advice or some experience. I think that's been really useful to me over the years, just to kind of know I'm not the first person going through something, and the decisions that we're having to make, others have done them. Some have been successful, some have failed. use that knowledge and experience.
If I may add a little bit more to here, is that I think building the business and going along the path is as an entrepreneur, as a technology innovator, we need to be able to build the assets in the business. And these assets, they are not necessarily like lands or like buildings and things like that. Sometimes your IP is your asset. So protecting the IP and coming up with the right intellectual property and those patents that protect your software, your hardware, your idea, whatever they are in your business is key. Because at the end of the day, as an entity who have started your business just recently and is going to grow, that asset, that IP asset will play an important role, because that is basically going to really establish that value in your business. That, for example, first of all, this IP is applicable to this line of product that I do. Also, it can be applied to a variety of other products. For example, in our case of like technology, we have been able to use this IP not only for the surgery room, but also for the general public, for elevators, for kiosks, for so many other applications. So that's important to have this diversity in the patent portfolio and protecting that and considering that as a real asset in the business.
Thanks so
Just
much.
want to build a little bit on what Simon was saying a little bit as well, which is, as a CEO, you're lonely. It's a very lonely job. There are lots of questions that are going on in your head. And, there are a couple of realizations that I think are helpful along the way, which is number one is you don't need to do everything yourself. You just need to get everything done, which means you need to have a team around you that's capable of filling in for your weaknesses. Not that I'm sure anybody here has any weaknesses, but if you did have the weaknesses, you'd want people to fill in around them. And that's one piece. And then the other piece is talk to as many people as you can. And solicit as much input as you can. You don't need to follow all of the advice. That's your job, is to actually sift through it and figure out which kernels are the ones that you are going to take and you're going to pursue. But the more input you get from people, the better. And, you have to realize that, press releases and so on are kind of like Instagram feeds for teenagers, right? Those are the beautiful, wonderful outcomes, and they don't necessarily belie what's actually happening underneath. So if you can have a wonderful group of other CEOs and so on, where you can actually have some candid conversations with them about the challenges that you're having and what they have done to address those, issues that you're facing, that will be immensely helpful.